All right, folks, while many people focus on BRICS nations and others that are dropping the dollar, what we've been pointing out too is that we have our allies that are also dropping our dollar, ditching our bonds, and we now find ourselves in a currency war against our own allies, including now Japan, which has seen their currency struggling against the US dollar as of late. We've now hit a level on the Japanese yen that we haven't seen since 1990. And the Japanese yen has completely collapsed here in the last few weeks, folks. And so we're going to break this situation down, what this means for you as an investor, whether you're an American or you're, part of our worldwide audience. What does this currency war, what does the Japanese yen crashing mean? And how can you relate this back to maybe your country's currency that is now, going to be up against the US dollar, which remains the cleanest shirt in the closet, but we continue to paint this picture for you. You got the cleanest shirt in the closet, but the house is on fire. And it's a house of fiat currencies and lies perpetuated by central banks that have completely sold out the people. Let's get right on into it, folks. Taking a look at this article here from Bloomberg. Japan amps up intervention threat as yen hits lowest level since 1990. Finance Minister Suzuki promises bold measures if needed. The yen may quicken drop if 152 barrier is broken, traders are saying. So let's slide on over here to the chart. And this is that 152 level that we're looking at. It's at 151 right now. We've done a triple tap on this level here in the last year. Okay. But we have not surpassed this level. We have not gone to this level all the way since 1990. So this is what they're talking about right here. We have a currency collapse underway. So reading this article, Japan had its toughest warning yet for traders on its willingness to intervene in currency markets after the yen slid to its weakest level in about 34 years against the dollar. The nation's currency dipped to 151.97 versus the greenback early on Wednesday in Tokyo, beyond the level at which policymakers stepped in during October 2022. Before comments from the government officials on their readiness to act boosted the yen to its strongest level of the day. Quote, "We are watching market moves with a high sense of urgency," Finance Minister Suzuki said. "We will take bold measures against excessive moves without ruling out any options." Suzuki's reference to bold action is generally interpreted to mean direct intervention in the currency market. And so here's your chart right here, right? Masato Kanda, the top currency official, later reiterated the message that speculative moves in markets wouldn't be tolerated following a three-way meeting between the ministers, the central bank, and the financial regulator. The yen's rapid decline comes even after the Bank of Japan raised interest rates for the first time since 2007. Now, I've shown you guys this chart. If you go back and you look, Bank of Japan raising rates has been an indicator, a leading indicator of recessions, for the past 40 plus years. Okay, so when we noted that Bank of Japan finally raised rates, we knew what signal that was sending. A lack of guidance pointing to further near-term policy tightening and the central bank's insistence that financial conditions will remain easy have instead pushed the yen in the opposite direction, something that traders have jumped on. While Konda said the BOJ would consider addressing the situation with monetary policy if currency moves hit the outlook for the economy or inflation. The central bank is seen as unwilling to risk more than a decade of work to generate price pressures by charging into a series of rate hikes to support the yen. That leaves Japan looking to the Federal Reserve to start cutting U.S. rates, a move that should indirectly bolster the yen by weighing on the dollar. But markets suggest that move is still months away, with swaps pricing the first Fed cut in July. And this is what we've been warning about, that the Fed is nowhere near. They can't cut until it breaks. And, with inflation still running hot, this is, they expected 6 rate cuts last year. They expected 7 this year. Now the expectations have finally dropped to 3, and now they're pushing the first rate cut out till July. That's still yet to be seen, right? It all points to a growing tug of war between policymakers and markets over how far the yen can fall. Traders already see 152 yen per dollar as the next line in the sand and have established options bets to capitalize. So, guys, let me just make this very simple for everyone to understand. When our Federal Reserve is raising rates, bolstering and strengthening the dollar, right, it's making all of the other currencies weaker. The other thing, compared to the dollar, all these other currencies are getting weaker, and a lot of these, countries, other governments, other central banks, and many companies around the world have debt denominated in U.S. dollars as well, and so this is hurting all of these folks worldwide. Imagine your business, you're getting paid in Japanese yen, you're getting paid in some other currency, but you got to pay off debts in U.S. dollar, right? And this is where they've, gotten themselves into trouble. And we've seen central banks around the world now posting historical losses on their bonds, right? Because of the move by the Fed to raise rates and bond yields rising, right? This is squeezing out people around the entire world. And so it's very interesting. The pain that is being inflicted on the middle class of America is a sacrifice that the Fed is willing to make because it's weakening all of the other currencies around the world. Let's continue on reading this one. Hedge funds and asset managers combined held a near record level of bearish positions against Japanese currency last week, according to data from the Commodities Futures Trading Commission going back to 2006. Given recent history, a breach of 152 could instigate intervention, said Rodrigo Catrill, a senior FX strategist at National Australia Bank in Sydney. The break of the previous high has accelerated the move, he said, referring to the dollar yen. Authorities in Tokyo spent 9.2 trillion yen, equivalent to 60 billion US dollars in 2022, to prop up the yen on 3 occasions, each time insisting that they were not protecting any specific currency level. Yeah, sure. Now imagine that, guys. They backed up and propped up with $60 billion. 9 trillion yen. By staging the first three-way meeting between the ministries, the central bank since May, Japan's authorities have left themselves with very few remaining options to ramp up the fear factor for speculators. This is the thing, guys. These other countries don't have many options with their central banks and the monetary policy that they can take on. Investors expect interest rate differentials between Japan and other developed economies, notably the U.S., to remain wide even after the BOJ ended the world's last negative interest rate regime last week. That's right, folks. They had a negative interest rate policy over there in Japan. That's undermined the yen as investors favor high-yielding currencies elsewhere. 10-year U.S. Treasury bonds are around 4.2%, about 3.5 percentage points higher than their Japanese counterparts, close to the biggest gap in the past decade. Now, I'm going to tell you what the problem is here for the United States and our Treasury and our Federal Reserve is the fact that now these countries are selling off because they're struggling back home. Their currencies are failing. They need to be able to cover themselves. They're selling off our bonds. So this is why, as I started off the episode, a lot of folks are worried about BRICS dropping the US dollar, countries like China that are dropping our bonds at the fastest pace since the great financial crisis, but it's also our allies. Look at Saudi Arabia doing deals outside the US dollar. Look at Japan. It's almost a boomerang effect. While yes, we're inflicting pain on them, they're also going to be forced to drop our bonds. And what have we seen happening at the most recent Treasury auctions? Barely anybody showing up, especially foreign investors, right? Now, they have been showing up and they have been buying because that yield has gone up, right? Because the Fed's raised rates, the yield on these bonds has gone up. And so it has been really attractive for many people to allocate towards bonds, get 4%, 5% on your money, relatively risk-free. Personally, I don't like doing a deal with the devil, or in this case, the US government, and having them as a counterparty. I don't really want to lend them money, but for many people, it is an attractive move, especially on the short-term T-bills, right? You're talking about 3-month, 6-month, and even shorter T-bills where you can just roll this over and you're getting that, 4 or 5% yield. And so once again, the cleanest shirt in the closet is the US dollar, but in the fiat currency house, the house is on fire, right? And so this is what we're going to continue to watch here as America remains the number one reserve currency by far, by and large, but we are losing our share of that. On the flip side, right, you have one part, people using the currency for settlement transaction. That's one part of a reserve currency. The second part is people having debt denominated in it and assets in it and using it as a store of value, i.e. bonds. And so we're watching as folks are dropping our US dollar for trade and for settlement, and they're dropping our bonds. And although the Fed, they have two battles here. They're fighting inflation back home by raising rates, but it's also inflicting pain across the world, which they don't mind. But in turn, it's forcing these countries to dump US bonds. It's, leading, other foreign investors to not want to show up. I mean, imagine this. Would you lend your money to the US government that's already $34 trillion in debt? They just added another $1.2 trillion bill that's going to fund us through the rest of the year. Imagine that, right? $1 trillion only funds us for 6 months or whatever it is, right? And they have over $150 trillion in unfunded liabilities, and you want me to lend money to them? Thank you very much, but I think I'll pass on that one. You guys let me know in the comments down below, but this is the dominoes starting to fall right here in this currency. It's a debt, currency, and liquidity crisis, and it's hitting home right now for Japan. This is going to be one of the first dominoes to fall. We'll be watching this closely. If you guys appreciate our updates, please make sure that you visit my website, ZachRector.com, for all of our other community resources. And on the way out, if you guys could please make sure you smash it, tap it, do something with that thumbs up, drop a comment down below, and let me know what you think about this ongoing situation. And let's make sure that you guys are protecting your families, your business, and your investments against what is taking place. I appreciate all of you guys, and we'll see you in the next one. God bless you all. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.